Good morning, everyone. Chad Krober here, your purpose-driven lender, and I'm coming to you here in late June and wanted to just share with you some of the observations and information that I'm seeing in the marketplace and just try to summarize it for you based on what we are experiencing now and maybe what we could potentially see in the coming months and future. So first of all, obviously, encouragement in the COVID vaccination realm. We are seeing high percentages of response levels across the nation, and the economy is benefiting from that, obviously. And we are seeing many return to work. We're seeing many industries open back up and begin to press on the accelerator at a high level. What that is doing, though, it is creating high demand, but the challenge is many industries during COVID backed off production. They backed off their pipelines effectively. And so what has happened is the demand is there, but the distribution channels and the volume en masse that has normally been there in the past is not there. And so it is creating extreme demand, and it is creating a lot higher inflation readings in the marketplace than what we are typically used to. This last month, we came out with a consumer price index reading that was near 5%. That is the highest reading that we have had in inflation since 2008. And that is initially not a great indicator of what we can expect from a cost of goods standpoint. But the Federal Reserve, in their comments this last week, expressed that they believe that this is fueled more by the lack of the amount of goods and items that are needed by the consumer because these companies and manufacturers are catching up their pipelines, they're catching up to the demand. They believe that this inflationary marker will begin to come back down. It will subside as the pipelines are filled, as the manufacturing levels increase. And they expect to see inflationary levels come back down near probably 3%, hopefully even into the mid twos, which is where it would be much preferred going forward by the end of the year. Obviously, the only way we will know is when we get there, and we'll see what happens. The Federal Reserve has also announced in the last week that they are not wanting to increase the prime rate or other tools that they have in their toolbox for what banks charge each other and for what the Federal Reserve charges banks for borrowing money. They are not wanting to raise any of those rates until 2023. So as we keep an eye on the consumer price index, inflationary measurements going forward in the next half year, and see where those numbers land, that could influence if the Federal Reserve increases rates sooner or if they hold to this timeline of 2023. So what does that mean to us here in the mortgage world and to you as the consumer of where interest rates will go for mortgage interest rates? The great news is that interest rates are still historically low. I am shocked and frankly bamboozled by the fact that we still have rates in the threes, in the high twos, and it is still an opportunity of a lifetime to secure a home for a primary residence, a second home, vacation home, a rental property, find ways to diversify your assets. It's just an amazing time that we are living in right now, and we will probably never see rates this low when they begin to go back up at some point. Obviously, no one saw COVID coming or the dynamic of how it would affect interest rates going forward. But to take advantage of the rates where they are in the mid and high twos up to mid and low threes, depending on the product and the solution, it's still an incredible opportunity and a lifetime opportunity. So With that in mind, if you want to have a mortgage review, if you'd like to look at consolidating debt, if you'd like to look at taking cash out of your property, if you want to talk about diversifying your portfolio and look at buying a rental property or a second home, please reach out. We're here to help, and I hope you have a great day.